So in here I want to explain about the financial reporting statement. So the accuracy of financial reporting, particularly in explaining the statement of financial position, is essential for assessing a company financial health and stability. This financial statement provides a structured overview of entity assets, liability, and equity at a specific point in a time, offering critical insight into its liquidity, solvency, and overall financial position. A well-prepared statement of a financial position enables investors, creditors, and other stakeholders to make informed decisions regarding resource allocation and financial risk assessment. However, certain limitations must acknowledged, such as the reliance of historical cost accounting, so the necessity of making estimates and the exclusion of certain intangible assets that may hold significant economic value. So, despite these constraints, this financial statement remains a fundamental tool in a corporate financial analysis and reporting. So, similarly, equity plays a vital role in defining a company financial structure, representing the residual interest of stakeholders after all liabilities have been accounted for. It encompasses key components such as share capital, share premium, retained earnings, treasury share, and other comprehensive income. So the dynamic of equity, including stock issues, definite distribution, and share buybacks, directly impact a company's financial flexibles, capital structure, and long-term sustainability. Effective management of equity ensure a financial stability, enhance investor confidence, and support strategic business growth. So both the statement of financial position and equity serve as indispensable element is a financial report contributing to transparency and accountability in corporate financial management. So ensuring accuracy in their preparation and presentation is not only a regulatory obligation but also a crucial factor in maintaining stakeholder trust and facilitating sound financial decision making. A comprehensive understanding of these financial components enables stakeholders to assess a company's performance, risk exposure, and future growth potential, ultimately fostering a more stable and efficient financial environment. So in here we gonna talk about statement of financial position. So the statement of financial position, commonly referred to as the balance sheet, is a financial statement that provides a snapshot of an entity financial condition at a specific point in time. So in here we're gonna talk also about purpose of function of the statement of financial position. In here, in number one, we have report assets, liabilities, and equity at a certain date. For the assets, in economic research controlled by the entity from which future economic benefits are expected, like cash, account receivable, inventory, property, plant, and equipment. For the liabilities, obligation of the entity to other parties that must be settled in the future, like account payable and bank loans. And the last one, for the equity, we have the residual interest in the assets of the entity after deducting all its liabilities, often referred to as owner's capital or shareholder's equity. And in number two, we have provide information on resources liability to creditors and net equity. So this shows how the entity has obtained and utilized its resources, especially the assets, as well as the obligation it must fulfill. So, net equity indicates the owner claims on the entity assets. And the last one, in number three, we have assess in predicting the amount, timing, and uncertainty of future cash flow. So, by examining the composition of assets, liability, and equity, user of the statement can gain insight into the entity's potential to generate cash and meet its obligation in the future of intense. A high level of liquidity asset might indicate the ability to meet short-term liabilities. So, in essence, the statement of financial position is a financial snapshot of a company at a single point in a time, detailing what the company owns, like assets, what it's on the liability, and what belong to its owners, like equity.
Now we're talking about the usefulness of the statement of financial position. First is calculating rates of return. Two is evaluating a company's capital structure. Three is assessing financial risk and future cash flows. And four, analyze a company's liquidity, solvency, and financial flexibility. Is we're talking about limitation of the statement of financial position. First, most assets and liabilities are reported in historical asset. Two, companies use judgment and estimate it. And last, omits many items that are of financial value. And here's the classifications. To classify items in financial statements, companies can report separately. First, assets and liabilities with different general liquidity characteristics. Two, assets that differ in their expected functions in the company's central operation or other activities. And three, liabilities that differ in their amounts, nature, and timing. The three general classes of items included in the statement of financial positions are assets, liabilities, and equity.
Okay, I'm gonna explain about element in statement of financial position. There are three main elements in the statement of financial position. First, asset. Second is liability, and the last one is equity. Okay, I'm gonna explain about asset. What is asset? Asset a present economic resource controlled by by the entity as a result of past event. An economic resource is a right that has the potential to produce economic benefit. Okay, there's four type of asset. First, current asset. Second is non-current asset. Third is intangible asset, and the last one is other asset. First, current asset. Cash and other asset a company expects to convert to cash, sell, or consume either in 1 year or the operating cycle, whichever is longer. Example like PT cash in bank, and account receivable, and inventory. Okay. Next is non-current asset. Are those not meeting the definition of current asset. They include a variety of items as we discuss in the following section. First, long-term investment or investment. For example, bonds, ordinary shares, long-term notes, and second, property or equipment. For example, tangible long-life asset used in the regular operation of the business. Okay, next is intangible asset. Assets that lack physical substance and are not financial instruments, like patents, copyright, franchise, trademark, a company worth of amortized limit life intangible asset over their leisure or legal life or their useful life. Next is other asset. Other assets vary widely in practice. Some include items such as long-term prepaid expense and not currently receivable. For example, special fund, property held for sale, and restricted cash or securities. And this is illustration how asset is present.
Okay, now I will explain about liabilities. So liabilities consist of two types. The first is non-current liabilities and the second is current liabilities. So the first is non-current liabilities. So non-current liabilities are obligations that a company doesn't reasonably expect to liquidate within the longer of 1 year or the normal operating cycle. Instead, it expects to pay them at some date beyond that time. And the second is current liabilities. So current liabilities are the obligations that a company generally expects to settle in its normal operating cycle or 1 year, whichever is longer. So there are three types of non-current liabilities. So first is obligation arising from specific financing, such as issuance of bonds, long-term lease obligations, and long-term notes payable. The second is obligation arising from the ordinary operation, such as pension obligations and deferred income tax liabilities. So the last is obligations that depend on the occurrence or non-occurrence of one or more future events, such as service of or product warranties, environmental liabilities, restructurings, often referred to as provisions. And there are three types of current liabilities. So first is payable resulting from the acquisitions of goods and services, such as accounts payable, salaries and wage payable, income tax payable, and so on. And the second is collection received in advance for the delivery of goods or performance of services, such as unearned rent revenue or unearned subscriptions revenue. So the last is other liabilities whose liquidations will take place within the operating cycle or 1 year. So such as the portion of long-term bonds to be paid in the current period, short-term obligation arising from purchase of equipment, or estimated liabilities such as warranty liability. Estimated liabilities are often referred to as provisions.
So I'm going to explain the equity. Equity, as known as shareholders' equity, is the residual interest in the assets of the entity after deducting all its liabilities, and it represents the owner's stake in the company. There are 6 components in equity sections. The first one is share capital, share premium, retained earnings, accumulated other comprehensive, treasury shares, and the last one is non-controlling assets.
We're going to talk about the preparation of the statement of financial positions. So the first one that you need is the account form. Usually, a lot of companies uses control mode, which assets by the section is on the left side and liabilities and equities accounts on the right side. And the next one that you need is a report form. The report form lists the sections in order from top to bottom. For example, the section starts with assets and then it continues down the way with liabilities, and also equities. So why does asset is on top? Because it really shows how the companies is doing well by subtracting the assets to liabilities and also the equities, so that it goes balanced in the end.